Hello and welcome to the Money Goose podcast. Thank you for joining the both of us today. Today we will be talking about how to save and invest at every stage of your life. I've noticed people talk a lot about how your money goals shift as you get older, but it can feel so vague. Why do these priorities actually change at each stage of life?
Honestly, it's because real life needs change way more than most of us expect. In your 20s or 30s, you're usually focused on just staying afloat, paying rent, maybe chipping away at student loans, and trying to save a little. But fast forward 10 or 20 years, and suddenly you're juggling a mortgage, kids, or even planning for retirement. It's almost like your financial to-do list keeps getting rewritten.
That makes sense. I've definitely felt those shifts myself. What I thought was urgent in my first job seems a lot less important now. So let's dig into what people should actually do when they're just starting out. Where should someone focus first?
In those first few working years, the two real musts are building up an emergency fund and dealing with any high interest debt. Think of it as your financial safety net, 3 to 6 months of living expenses. Minimum.
I can remember being told to save for emergencies, but never really knowing what counts as an emergency. Is this just for job loss, or does it cover things like unexpected medical bills or car trouble too?
It's all of the above, anything that could derail your budget if you weren't prepared, like a surprise root canal or your car's transmission quitting. And while you're building that fund, tackling credit card balances is next, especially if they're at those brutal 15-25% interest rates. That kind of debt grows way faster than any investment could offset.
Ouch, those rates really bite. Once someone's got a handle on debt and some emergency savings, what's the next move?
The earlier you start saving for retirement, even a small amount, the more magic you get from compounding. If your employer offers a 401k match, grab it. That's basically free money.
Can you unpack how much that really adds up? I think people underestimate those matches.
Absolutely. Let's say you make $60,000 and your company matches the first 4% you contribute. That's $2,400 a year just handed to you. And over decades, those matched dollars and your own grow together. Even automating 10% of your paycheck into retirement makes a world of difference.
It's so easy to put off, but those numbers make it hard to argue with starting now. What about where to put that money? There are so many account types.
Great question. Generally, you want to fill up your tax-advantaged accounts first, like 401 for the match, and then maybe a Roth IRA if you expect your taxes to be higher in the future. After that, a regular brokerage account gives you flexibility for things you might need before retirement.
So that Roth IRA, you pay taxes now, but your growth is tax-free later. That sounds ideal for people who think they'll earn more down the road.
Exactly. If you're starting your career and earning, say, $50,000, it's a smart time to pay taxes up front before you hit higher brackets. And brokerage accounts, while less tax-friendly, have no withdrawal rules, so you can use them for other goals too.
Speaking of choices, what about the actual investments? Should people chase hot stocks or stick to something else?
It's hard to overstate how much fees eat into your returns. For most people, sticking with low-cost index funds or ETFs is the way to go. These cover the whole market without betting on a single company, and expense ratios under 0.1% are common.
I've read about people paying over 1% in fees and not realizing the difference. That can drain tens of thousands over decades, right?
Totally. A high-fee mutual fund can cost you a small fortune compared to an index fund, purely through that drag. Plus, with a simple 80-90% stock allocation when you're young, you're setting yourself up for growth. You'll shift more to bonds over time, but early on, stocks are generally the growth engine.
Speaking of growth, I'm curious how much those small, regular contributions can really add up to over time.
Even if you're just investing $200 a month, with average returns around 7%, you could end up with over $225,000 after 30 years. It's wild how steady, automated investing outpaces trying to time the market.
That's pretty motivating. I like the idea of setting and forgetting, automating it so you don't have to think about it every payday. Um, should people also be rebalancing their portfolios as they go?
Definitely. Once a year, just check if your investments have drifted too far from your target split. Maybe stocks boomed and now you're taking on more risk than you realize. Rebalancing keeps things aligned and stops one area from dominating.
Okay, so now let's fast forward to mid-career. People's lives look very different by then, right?
Absolutely. By your late 30s or 40s, you might have a family, a mortgage, and higher earnings. But with bigger paychecks, come bigger expectations, saving for college, growing an emergency fund if you have kids, and stepping up retirement contributions, ideally to 15–20% of your income.
I've seen people wonder whether they should pay off their mortgage faster or invest more. Is there a clear answer there?
Not always. If your mortgage rate is low, say under 4%, investing extra can often beat paying it down early. But a 6–7% rate is a different story. It's about balancing guaranteed savings versus long-term growth, all while making sure you never miss that employer 401k match.
And that's a good point. Is this also the time to diversify investments more?
Exactly. With more cash flow, you can add things like international stocks, small cap funds, or even REITs for real estate exposure. Keeping 60–80% in equities often works, but it depends on your comfort with risk. Target date funds are popular too. They adjust for you automatically.
I've heard about people holding too much of their company's stock. Is that a hidden risk?
Big time. If 20% or more of your net worth is in one company, especially your employer, you're exposed to both job and portfolio risk. It's smart to gradually sell down concentrated positions and use different accounts for tax efficiency.
What about saving for big life goals, like a home or kids' college? That seems to get more urgent in these years.
For big goals, it helps to open separate savings accounts, one for the house, another for college. That way, you can track progress and not dip into those funds for daily spending. For college, 529 plans are great because of their tax benefits.
And what investment mix makes sense for these different timelines?
Short-term goals, say, under 5 years should be in high-yield savings or short-term CDs, not stocks. For goals beyond that, adding some equities is fine, but the closer you get, the safer you want to be. Automating those savings takes the guesswork out.
I love that practical angle. So let's fast forward again. What changes as people hit their 50s and 60s on the road to retirement?
This is when maximizing savings really matters. If you're 50 or older, you can make catch-up contributions up to $23,000 into a 401k plus an extra $7,500 as of 2024. It's the last chance to close any gaps before retirement.
That's a big boost. How do people figure out if they're actually on track for retirement?
Run a gap analysis. Subtract what you'll get from Social Security or any pensions from your expected expenses and see what you need to cover from savings. The usual 4% withdrawal rule is a rough guide, so for $40,000 in annual needs, you'd want about a million saved.
But healthcare and inflation can really throw a wrench in those numbers, right?
Absolutely. Medicare doesn't cover everything, especially long-term care, which can run six figures per year. It's also smart to consider guaranteed income sources like annuities or delaying Social Security for higher benefits. Inflation can slowly erode your buying power if you go too conservative too early.
So, do people need to shift their investments as retirement approaches? I've seen some panic and go all cash.
Going 100% cash is risky because your money can't keep up with costs over decades. Most people transition to something like a 60/40 or 50/50. Mix enough stocks to grow, enough bonds and cash to cover near-term needs. It's a balancing act.
How do you protect yourself from having to sell stocks in a down market, especially right after retiring?
A popular trick is to keep 2–3 years of living expenses in cash or short-term bonds. That way, if the market tanks your first year of retirement, you aren't forced to sell stocks at a loss. It's like a buffer for bad years.
And what about actually pulling income? Is it all about strict percentages or are there more flexible ways?
It's smarter to be flexible. Guardrails are better than rigid formulas. If your portfolio drops, cut back withdrawals temporarily. Some folks use the Guyton-Klinger rules or base withdrawals on a moving average of their portfolio. It helps you ride out volatility without running out of money.
That actually reminds me, what's the best order to tap accounts for income taxable? IRA or Roth?
Most retirees pull from taxable accounts first while letting IRAs and Roths grow. But those rules can change if you have a super low tax year, then it might make sense to do Roth conversion. Planning when and how much to withdraw can save a ton on lifetime taxes.
I've had friends surprised by required minimum distributions bumping them into a higher tax bracket. Can people do anything to soften that blow?
Definitely. If you convert some IRA funds to Roth before RMDs start, ideally during low-income years, you can reduce forced withdrawals later. Plus, getting the sequence right means you aren't forced to sell stocks at a bad time just to meet tax rules.
So, looking at the grand sweep, what would you say are the biggest takeaways for each life stage?
If I had to boil it down, early on, build your emergency fund, Grab that 401k match and stick with low-cost index funds. In midlife, ramp up contributions, diversify, and keep debt in check. Nearing retirement, focus on preservation, income planning, and making your withdrawals and taxes as smooth as possible.
And whatever your stage, automating savings and checking in at least yearly sounds like a no-brainer. That way you can adjust as life and the market change.
Exactly. The habits matter more than trying to pick the perfect investment every time. Start small, stay consistent, and review your plan now. And then that's what really moves the needle, whether you're just starting out or planning your legacy.
Thanks so much for sharing this step-by-step practical approach. Money can feel overwhelming, but breaking it down like this goes a long way.